If your boss offered you a pay rise, but that would take you into a higher rate tax band and so you'd pay a little bit more tax, would you turn the pay rise down? Would you? Didn't think so. Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based here in the UK. And for more than 10 years, I've been giving you everything you need to know and everything you need to do to secure your financial future. Now, I've seen a few videos recently, most notably this one from Sasha Yanchin, which talks about possibly stopping paying into your pension in case you breach the pension lifetime allowance. Indeed, the title of the video is Why You Shouldn't Pay Into Your Pension. Now, I really like a lot of Sasha's stuff, but I had to respond to this one because to my mind, not paying into a pension because of a potential tax charge years down the line is just madness. And I want to show you why. So I'm going to briefly explain how the lifetime allowance works. This is important because understanding how it works removes a lot of the fear of the unknown. Then I'll show you how it makes more sense to plan for the lifetime allowance rather than try to avoid it. And then finally, I'll suggest that actually you shouldn't care that much at all. So if you're ready for all that, let's talk about how the lifetime allowance works. The lifetime allowance, from now on I'm just going to call it the LTA, okay? The LTA is a limit test which is applied to your pensions at various points in time. Current LTA is £1,073,100. In his video, Sasha Yanchin says that this is the maximum that you can have in your pension. But that's just not true. You can have as much as you want in your pension fund, but I do get his point. Over that amount, you may be taxed with the lifetime allowance charge. But your pension provision is only tested against the LTA at so-called benefit crystallization events. Events, points in time. Now there are 13 of these. But let me simplify them by saying that really there are three main points in time when your pension provision is tested against the LTA. 1, when you take money out from a pension. 2, if you die before age 75. And then number 3, at age 75. Now, how your pension provision is tested against the LTA depends on what kind of pension it is. So check out this video that I did explaining the different types of pensions if you're not sure about this stuff. If it's a defined benefit pension, where you get a guaranteed income for life, then the amount of annual pension that you get when you first take your benefits is multiplied by 20. If you get a lump sum as well, that is then added on top. So if your pension is £25,000 per year gross, multiply that by 20 to get £500,000. If your lump sum then is, say, £125,000, just add the two together and you get £625,000. And that is the figure that is tested against the lifetime allowance. If you're over that, you'll get a tax charge. Now, if you have a defined contribution pension fund, then however much of that fund that you crystallize to take benefits out is tested against the lifetime allowance. Only if you crystallize more than the lifetime allowance will you get a tax charge. More on that in just one sec. But if you take out any excess over the lifetime allowance into your bank account as a lump sum, then you will pay, wait for it, 55% lifetime allowance charge. Eye-watering. If you take the excess out as income, you will only pay 25% lifetime allowance charge, but then you'll pay income tax on top of that. So let's say you crystallize £100,000 over the lifetime allowance limit. You take it as an income payment, and you pay 25% lifetime allowance charge on it first, leaving £750. Then you have to pay income tax, which if you're a higher rate taxpayer is at 40%. 40% of £750 is £300 in tax, which leaves just £450 out of the original £1,000 excess over the LTA. So that's a 55% tax rate, whichever way you slice it. If you're wondering what on earth I'm on about, talking about crystallization and all that stuff, check out this video about how UK pensions work at retirement. And if you're interested in more focused learning on this stuff, check out Meaningful Academy Retirement Planning, where I go into much more detail about all these issues and how to plan for them. As part of the course, you get access to state-of-the-art planning software called Voyant Go, which can really help you plan and model all kinds of scenarios, including lifetime allowance planning. It's the best place I know to really get to grips with all this stuff. So check out meaningfulacademy.com for all the info you need. Now, let's dig in just a little bit deeper because it'll help you get a sense of whether or not the lifetime allowance really is a big deal or not. Stay with me, I know it's technical, but we're doing really well. Let's talk about planning for the lifetime allowance. Now, if you're a high earner and you have a defined benefit pension, the kind with a guaranteed income, well, your planning options are going to be fairly limited. The scheme is going to pay you out no matter what. You could maybe take the pension early, meaning you'd receive less income for longer, and then you'd have a lower figure to test against a lifetime allowance. And there might be some other options, but you won't have many. The guarantees of DB schemes, which make them so valuable, are also the reasons why many people breach the lifetime allowance with them. If you do end up breaching the lifetime allowance, then you can ask the scheme itself to pay the lifetime allowance charge for you. That's called the scheme pays option and is always paid at 25% rate. For defined contribution schemes, remember that it's only the amount that is crystallized that is tested against the lifetime allowance. So let's say you have a big pension fund, which is well over the lifetime allowance. You decide that you want £25,000 in tax-free cash, and the other £75,000 goes into a drawdown pension fund where you can take money out of that as income. Well, you've crystallized £100,000, and it's that figure, 100 grand, that is tested against the lifetime allowance. And then a note is made of the percentage of the lifetime allowance that you have used. In this case, £100,000 is 9.32% of the current lifetime allowance. And that means you've got 90.68% of the lifetime allowance still to use for future crystallizations. And if the LTA does rise in future, you'll have 90.68% of the higher lifetime allowance at the time of your next crystallization. Each subsequent crystallization takes up a little bit more of your LTA until, if your pot is big enough, you might end up breaching it and then paying an LTA charge. But pensions flexibility means that you can plan your crystallizations, firstly around your needs, but also with a mind to the lifetime allowance maybe. A couple of other things to mention: if you die before age 75, anything that you haven't already crystallized, plus the growth on any money that you have crystallized, will be tested. And if you make it to age 75, then your provision will be tested at that point too. But here's the kicker, folks. Because you know when those tests are going to happen, you can plan to a pretty large extent. It's one of the reasons I have a job. It is not the case that as soon as your pension provisions cross the threshold, some humorless guy in a grey suit from the revenue is going to be knocking at your door demanding payment of the lifetime allowance charge. So can we please just chill out a little bit about this? Really, it's no different from capital gains tax or even income tax. All these things can be planned for and mitigated legitimately to a point, and the lifetime allowance charge is no different. And again, you wouldn't turn down a pay rise to avoid a higher rate of income tax. So why would you forego the incredible benefits of pensions just in case you get taxed down the road? And finally, here's my biggest issue with the way Sasha presented this in his video, and why I think that you really shouldn't care about the lifetime allowance while you're building wealth. Sasha's example was intended to show that anybody could potentially breach the lifetime allowance, and he's not wrong about that. He used the example of someone earning the UK average wage in 2019 of £30,420 per year, and then never getting a pay rise. They contributed the statutory 8% into their pension and assumed 8% annual growth on their pension. And they ended up with a pot, after a 48-year career, of £1,252,041. And that is over the current lifetime allowance. Now, it's pretty unlikely that somebody won't receive a pay rise for 48 years, but if they do, that actually reinforces Sasha's point, because they'll have even more in their pension pot, taking them even further over the LTA. One would hope that the LTA charge would also rise by inflation to offset that a little bit, but it has just been frozen for another 4 years, so who knows? My biggest issue here is that Sasha says that the statutory contribution to a pension is 8%. It is not. An employee's usual contribution under the auto-enrollment rules is only 4%. The other 4% is made up of 1% tax relief and 3% employer contribution. So it's still 8% going in, but only half is paid by the individual. Now, if we follow Sasha's example, over a 48-year career, a total of £114,379 will have been paid into the pension. But of that, the individual themselves will only have paid in £57,190. The rest is free money from HMRC and from the employer. And yet, using Sasha's assumed growth rate inside the pension, they'll have a fund of £1.25 million. Folks, that's a 2,089% return on your money. I'll take that. On those figures, you would be over the lifetime allowance by £178,941. Worst case, that would give you a lifetime allowance charge to pay of £98,417, still leaving you with a pension fund of £1,153,624. 57 grand turns into 1.15 million, thanks to the magic of compounding, tax relief, and employer contributions. Would you turn that down to save some tax? Somebody says to you, here's £1 million, but you have to give me 100 grand back in tax. Would you say, oh no? Well, of course you wouldn't. So Sasha, in the extremely unlikely event of you watching this video, I totally understand what you're getting at. Like I say, for the most part, I'm loving your work, but it is way too simplistic for anybody to decide not to pay into a pension even as they approach the lifetime allowance, just to save that charge. I mean, we haven't even gone into the inheritance tax and estate planning benefits of pensions. 48-year projections are one thing, but if you're looking at your pension right now and thinking that you might fall foul of the lifetime allowance fairly imminently, you must not reduce your financial planning to simplistic, if this then that kind of statements. You might breach the lifetime allowance, so you should consider stopping paying into your pension. Maybe, maybe not. Each person is different, with many potential planning options. So please, please either seek professional advice from a chartered financial planner or educate yourself fully before navigating these waters. Well, I feel good to have that off my chest, and I hope the video was helpful. If it was, please hit the like button. That helps with the algorithm. Subscribe if you're not already. Thank you so much for watching, and I'll see you in the next video.